Welcome to the Market Outlet webinar with me, David Jones, in association with Aondo Markets. If you're watching the recorded version of this, it was held on Wednesday, the 15th of March at 12:30 in the afternoon. So this is a webinar we do every week on a Wednesday lunchtime. And we've slightly changed the format in recent weeks, but what we do, we'll look at sort of 4 or 5 interesting markets, but also do some education and strategy stuff. And the topic for today is spotting trend reversals and how to trade them. So we'll look at the theory of it, which is one thing, and then we'll look at the actual reality of it, which is another thing. I always end up doing these webinars when the restaurant next door is sorting out their recycling. So if you can hear bottles in the background, that's what that is. Let me just see, I'll close the window, make it a bit quieter. Right, there's the risk warning. It's been a bit of an odd week because the US Federal Reserve is due to make their monthly announcement this evening at 6 o'clock UK time, and the expectation is that we'll have an interest rate rise. It'll be the 3rd rise in 10 years. So we're probably going to have a pretty quiet day for markets. You know, whenever we have these big events, like the payrolls on Friday, last Friday, the US unemployment numbers, you know, markets do tend to sort of just sit there and mark time the day before. So I think we'll have a bit of a quiet one today. But I think that risk warning's been up long enough. So let's get into it. So the platform I use for all these is it's Aondo's trading platform. Here we go. It's Trade Hub. So Aondo are, I think, well known for their social trading, where you can copy other traders, and I do regular webinars with Aondo on that, and I blog about it on my website with a real account that I put, I think, £2,000 in at the beginning of Feb, and you can see that on tradeafter.com. But you can also do self-directed trading, you know, your own trades. So I thought what we'd start off with today, let's get into the strategy side of it, because it has been a couple of quiet days. Let's talk about some trading strategies, particularly focusing on the idea of trend reversals. And what I'm going to do, if this works, I'm going to introduce some new technology into the webinar. So brace yourselves. Let's see if this is actually going to work. Hold on. Not so far. Right, let me see. If I show, here we go. I'm very disappointed I can't get this to work. Hold on a second. Let's try flicking back to that. Show screen. Clean. Okay, right. I have one last go at this. Just bear with me a second. Here we go. Right. Can you just confirm that you can see a white screen there? If someone could just type in that they can see a white screen, and I know that's working okay, then I think we are in business. Perfect. And I just managed to hide it. Okay, so what we have. Oh, I knew I shouldn't do this. I'm too ambitious. So if we're looking, you know, at a traditional trend, if you're looking at a trend in a textbook, you know, it's always drawn, you know, like something like that, doesn't it? Where we have the trend goes down, and then whoever's written the book will plonk our trend line on there, and we'll say, okay, when that trend is down, we want to be looking to sell short. So rallies back to the trend line, we're looking to sell them. And then when this happens, bang. That's the break of the trend line. So again, I think plenty of classical technical analysis books will show that and say, okay, we want to be a buyer here. And then normally we'll go on to see that sort of thing happen. And isn't it all wonderful? You know, we make a load of money. Unfortunately, in the real world, you know, it doesn't actually work that way because it can be, you know, quite a bit messier than that. Yes, we get our downtrend, you know, but we'll often see, you know, if a trend line breaks like that, that break of a trend line doesn't necessarily mean that suddenly the market is going to be off to the races again. You know, we could see this sort of thing happen where it goes down and faffs about for a bit, and maybe even that happens where the trend carries on. So I think whilst trend lines have their uses, I think using them, you know, solely as like a trading strategy maybe isn't going to be that successful. So I thought we'll look at some real world examples and a way of maybe building bricks for setting up a strategy to trade these reversals. Because of course there are reversals. Markets do trend. So if we go over back to the trading platform, I think we've got a couple of recent examples. So what we're looking at here, if we looked at something like this is the Aussie dollar, okay, it's the Australian dollar, US dollar market, and I suppose if we were going to draw our trend lines on it, let's see, it might look something like this, the most recent downtrend that's ended. Okay, so we did see the market break above that level, and this is actually not a bad example. So the market broke through that level. So we've got maybe the first warning, the first signal that maybe the market is going to reverse that trend. But I would suggest not jumping onto that move straight away, because I think one of the problems is if you get a break of a trend line, the most important thing in trading is where does your stop loss go. Okay, so it's how much am I willing to risk to try and catch the next move. And I did some stuff on my website years ago that the most common reason that people lose money, there was a broker who did a survey of 4 million client trades, or analyzed 4 million client trades, and the problem was the average loser was almost twice as big as the average winner. So it's not that people are necessarily that bad at forecasting where markets are going to go. What they're bad at is getting that balance between the risk versus the reward right. So for me, one of the most important things is where does the stop go. So I would suggest that if you see, first of all, a trend line break, okay, that's our first signal, okay, maybe things are changing. But I think the mistake that I made in the early years was definitely jumping on, this is a dollar, Canadian dollar, not the Australian dollar, sorry, jumping on that break straight away and just putting a random stop loss in place, so buying it at 130, 150 in this example, maybe doing, I don't know, £5 a point, only wanting to lose 250 quid, so putting my stop loss 50 points away. And that's just a random stop loss. It's just the market doesn't care that you only want to lose 250 quid. And you see, I would have been stopped out if I'd have jumped on that at 31.50. All right, went up 50 points the next day, but it got knocked back, would have taken me out. And then lo and behold, the market goes exactly where I thought it was going to go. So I'd say use the break of a trend line as the sign to get your trading head on and start thinking about doing a trade, but don't necessarily jump in on the trade. And I'd say that the logic here is pretty sensible. I think when all's said and done, markets aren't that complicated. They go up, they go down, they go sideways. Making money out of it is the hard bit. But if this is a valid trend line break, then what should the market do? Well, clearly it shouldn't take out an important previous low. So for me, then it's a question of sort of looking at the maths or looking at the levels, sorry, and then doing the maths. Where's the important low? Well, before that trend line break, the lowest the market got before the break, we'll talk about this low in a minute, was 130.10. So for me, if I'm buying at 130, 150, my stop loss needs to go, I would suggest at the very least, and this is from experience of getting stopped out a lot in the early days, the other side of that major low. Because by definition, if this trend is breaking, the market should start going up. It may not start going up this second, this hour, this day, but it should not end up giving back and taking out a major low. And I would say probably the purer trade here is the stop under this low here, because by definition, if this is the end of that downtrend, there should be no more lows. It can chop about and faff about a little bit, but it should not take out this low. So for me, the technique when trading trends, and it does mean that I miss some reversals, but the technique is to try and buy in an uptrend by the first pullback. So when it breaks out, we want to see if the market weakens, do we get a better level to get in, which makes our risk sensible and our potential reward. And this did work out pretty well because the market went like a rocket. But we have the right balance between risk and reward. So I wouldn't sit there and blindly trade trend line breaks, but I'd use it as the start of the setup and then start thinking about where's my stop going to go. Because I think the mistake that plenty of people make, I've worked in the spread betting industry for sort of 10 years, people set their stop losses too tight. The mistake number one is not using stop losses. Mistake number two is setting those stop losses too tight. So you just get taken out in the noise. And you see this sort of thing all over the place. If we have a look at, let's have a look at euro sterling. I mean, this is, this is one we do regularly on these webinars that we take a look at. And euro sterling, similar sort of setups. If we went back in time, so we had the surge after the Brexit vote, then we'd have a correction, a downtrend. The market would break. Maybe didn't pull back very far then before taking off, but similar sort of moves here. The market, if we drew our trend line back on, what am I looking for? That. If we took this little bit of the trend here, say, where it looks like that, so the market was selling off. That was November. So for much of November, the euro against the pound was selling off, and then broke through the trend line, nudged through the trend line. Didn't make that much progress. But again, if you're trading off a trend line break, that's maybe your signal. And the setup was the pullback, where again, if we say, well, okay, I'm going to buy here, the market should not take out that previous major low, and so it goes on. The latest trend line break, this is the drawback of this approach, because if you're waiting for a pullback, if we drew, I don't know, if we drew something like this from here, if we were watching this for a pullback, the pullback never came. So this is one where the trend line did break and the market just motored higher. Yeah, so it does mean you are going to miss them. You're going to miss the sharp moves, but it also means the trades you do, if you're trading off these trend line breaks, you're hopefully having a sensible level of risk versus the reward side. It doesn't work all the time. There was an example last week. I got stopped out on it. I got back in again. I got stopped out on the pound against the dollar trade using exactly this sort of methodology. I was looking at it on a bit of a shorter term time frame. Where are we? Let's flip this over to an hourly chart. Here we go. So I was looking at, let me draw my trend line in. So it was, I don't know, it was something like that, I think. I can't remember. Something like that. So the market starts breaking and then breaks above the previous day's high, which is always a good signal for me. I bought in. I think I bought in about here somewhere. Because again, taking the view, well, if it's broken out, it shouldn't really be taking out these lows, these 120, 140 lows. So I had my stop at, I think it was 120, 130 in the end. The market did move. I think I bought in at 65, so the market moved about 70 points in my favor. But because I had a 40-point stop loss, I was looking for more of a move than that before I moved my stop. And the market, I think was it on the latest Brexit Article 50 stuff, market fell off a cliff, took me out, and has since bounced back. Yeah, but it's having the patience to wait for that sort of setup. And just because a trend line breaks, doesn't mean that it's necessarily the end of that trend. Let's take a look at maybe some of the US markets. But there's been, again, an interesting setup, I think, in the S&P. So this is the S&P 500. We'll have a look at the bigger picture in a minute. But just to stick with this idea of strategy and trading trend line breaks for a sec. The sort of thing, again, that I'd be looking at is something like this. If we're taking our trend line maybe off the S&P highs, then our trend line looks something like that. So it has a little faff around. So these are hourly candles we're looking at. So whether you classify that as a real break or not, I don't know. I probably wouldn't, because it's generally sort of spiked through on the hour. But maybe the truer break was March the 10th. Okay, early hours of March the 10th. The market runs away, so it breaks the trend line at about 23.65, runs up near 23.80. So again, for me, if it's 11 o'clock in the morning, I'm thinking, oh God, I've got to buy this. The problem is, the closest I want my stop is the low, the low before the break, because again, by definition, if this is a valid break, we shouldn't really be taking out those lows. But so if I'd have bought up there, my risk reward would have been pretty poor, I think, because my stop would have been probably nearly 20 points away, nearly 20 S&P points away, and my target is maybe only 20, 23 points up to here. So that's a really poor risk reward. So the better trade is to wait for the pullback, either buying this, either putting an order in to see if the market pulls back and getting your order filled, or even yesterday, when was that? Yesterday, 2 o'clock yesterday, where we had again this pullback back to that sort of that spiky low you can see from March the 9th. There we go. So the spiky low is at 23.54. The market yesterday, it spent a good 1, 2, 3 hours sort of faffing around the 58.60 mark before moving higher, moving sort of 12 points higher, 12 S&P points higher. So there's a way where we don't necessarily have to jump on the trend break straight away, but just be aware it's happened and then think about, right, where is my stop loss going to go on this trade? Okay, let's have a look at a couple of interesting markets, and then we'll talk maybe a bit more about strategy. Let's flip back to the pound quickly. I mean, the pound, it's probably the only thing that's moved much this week, and of course it's the usual Article 50, Brexit, all that shenanigans is going on. There's a bigger picture view for the pound. I must admit, I think I would expect a rally from here on the pound. Again, actually, let's go back to our little strategy. This is our daily chart. You know, we can see what an important level 120 has been in the past for pound against the dollar. Whenever we've seen weakness back to this level, we've seen the buyers come back in and push the market back up. You know, yesterday we touched almost 121, so it wouldn't surprise me to see possibly a bit of a base building down here. But with it being so politically driven at the moment, you know, it's definitely vulnerable to the odd peculiar move. But there's our break. You know, again, there's this whole trend line thing where the market had been correcting from December through to January, breaks, has a move up, comes back down. So again, if this break is going to be valid, you could argue, well, these lows need to hold. Those lows at 120 need to hold, and maybe it's time for the market to rotate its way back up to 128. So I think the big picture favours being a pound buyer down here. But if we look on the shorter term charts on the hourlies, you know, you can see just how volatile it's been. It's been, I think it's quite, in the last week or so, it's been a difficult market to trade. We've had a good trend, good downtrend for quite some time from the late Feb, but it's got a little bit scrappy again because of all this political stuff that's been going on this week. But I think from a bigger picture point of view, pound rally maybe down here. Let's take a look at another currency pair, the Aussie dollar, US dollar. This is an interesting one. I think this is an interesting one again from a trend reversal point of view, potentially a big picture point of view. I was trying to do a trade on this last week, like an options trade, but I didn't get filled. And what I was looking at, the market, the Aussie dollar, has had an incredible run off the 71.60 lows in December and as high as 77.20. You know, so what's that? 500 points plus rally we've seen in the Australian dollar this year. But it can't break this level. It cannot break this whole 77.20 to 77.60 to 78.40 area. Cannot break it. But it's still tradable. You know, it's still sort of tradable. And I'm just wondering, because we've seen a slide over the last, the last couple of weeks, last 3 weeks, we've seen a slide in the Aussie dollar. But going back to this idea of trading trend reversals, I think there's possibly, you know, hang on, if I can, there we go. So that's been our downtrends, which has capped this market pretty well over the last 3 weeks. But look what it's doing now. So what it's doing now is starting to break through that trend. So I think it's really interesting. It's one of the few interesting markets I think this week, because everything else has been marking time, waiting for the Fed. So we've got the first break of that downtrend line that we've had in 3 weeks. We have just about, it looks like, poked very briefly to those old highs. So there's definitely a trade here, and they're actually, just to confuse things, there's an argument to trade both ways. You know, if you thought, well, this is a false break, you could go short here with a stop maybe above that high. That would be an aggressive stop. A stop giving it a bit more wiggle room. It's going to be about 50 points away, 60 points away above that one. Or you may take the opposite view, and I think we just need a bit more time to try and figure out which one it's going to be. You may take the opposite view, that this is the start of a new uptrend, if I could draw the line properly. So again, the trade here would be, but if we're going to say, right, this is a valid break, we're going to be a buyer now at 75.86, and a stop loss. Where does our stop loss go? I think in an ideal world, the other side of here, down here somewhere, so below that absolute low, which is 70 points away. But maybe there's an argument for a tighter stop loss, and again taking the view, well, if the trend was down and it's changed, should we really be taking out these levels, these sort of levels down here? So I think the purest trade here is a stop over below here, if we think this trend is going to reverse and we're going all the way back up to 77.40. The more aggressive stop, I would suggest, would be under here, around about below 75.40. So I think that's an interesting one, because it's an example of what we've been talking about from a theoretical strategy point of view that it is a market that looks like potentially it's reversing. But everything else, everything else dollar denominated is all on hold a little bit until we get that Fed announcement this evening. Let's take a look at gold, because gold's been interesting. Gold, where are we? Gold spot, here we go. Gold spot. So we have had, just to recap, it's been a good year for gold. We came off the lows, 23rd of December, or ish lows, around about 11.25. We've rallied as high as sort of 12.60-ish this year, and it's come off. I must admit, I didn't expect it to come off this much, but if we plonk our trend line in, that trend line has definitely been cracked, and I think now that the last level to watch are these lows from back here. So I would still be moderately bullish. I'd still rather be a buyer than a seller when it comes to gold. But 1180, I think that was the level we were talking about last week, because last week we were here, so it's not moved much over the last week. But 1180, I think, is that the line in the sand for gold. So at the moment, I'd still be inclined to be a buyer rather than a seller. But let's have a look on the hourly charts and see what it looks like. So that is almost like a textbook downtrend, isn't it? So if we plonked our line, I think I might have to fiddle this a bit to get like a best fit, but let's see what it looks like. There we go, look at that. So looking at that, you'd argue the trend in gold is still down. So we had seen something of a rally March the 10th into March the 13th, and the rallies ran out of steam. So for me, there'd be no urgency to be a buyer just yet. If you wanted to go short, then for me, the logical place for the stop is above 12.12. Yeah, so it's above this previous spiky high. But I think it's going to be an interesting one to watch, considering that on the daily chart, there's the big level coming up. The first short-term level to watch, those 11.95 lows. Let's see how it performs around here. But gold, if we can make it through this trend line, it starts looking like the sort of setup we talked about right at the beginning. And if it pushed through the trend line the next couple of days, then again the trade is, from a technical point of view, be a buyer with a stop loss underneath that recent low, because by definition, if that trend's reversing, that low should not be taken out by gold sliding again. So I think that's an interesting one to watch. And of course, because it is denominated in dollars, that is going to see some movement when we get this Fed announcement a little bit later on today. Let's take a look at stock markets. We've seen there's someone I retweet on Twitter now and again, context analysis, and they push out statistical facts about markets. And I think one they pushed out was that the last 9 days have seen the Dow close lower than it opened. So every day the Dow has closed lower than the opening price, and we haven't seen that happen in something like 27 years. But so you'd think, well, this is a market that sounds like it's in free fall, but of course the size of the falls that we're seeing, they're pretty minuscule compared to the size of the rise that we've seen since Mr. Trump came to power. So let's just take a look, remind ourselves of the bigger picture here. So our Dow trends, and we'll have a look at the S&P in a sec. It's going to be pretty much the same. Our downtrend looks like that. There we go. So that trend is being threatened, but I think it's being threatened just by the market going, just by the fact, first of all, it's been such a sharp trend. The market's gone a bit sideways, so it's sort of plopped below that trend. But for me, that's not a valid trend line break just yet. But let's take a look at the hourlies, because again, this is going to be a market that just marks time today, you'd think, until we get the Fed thing out of the way. For me, again, I'd be inclined at the moment to be a buyer, because we've had, going back to the old trend strategy thing, when we looked at the S&P, it's the same sort of thing on the Dow. So the Dow managed to break out of this trend March the 10th. So when was that? End of last week. It's pulled back yesterday. Brilliant opportunity, perfect Harry hindsight trade from yesterday, where the market, those lows, so 7 o'clock UK time on March the 9th, the Dow dipped to 20,778 and then bounced a couple of hundred points off that level. Actually, it looks like, into the close, wasn't it? It was into the close, or maybe the next day, carried over the next day, the strength. But again, yesterday, right on the open, it looks like yesterday, in the first hour of trade yesterday, like the S&P, came back to those previous lows. So for me, my bias would be to be a buyer. So for me, if we did see any weaknesses, I wouldn't buy it this afternoon because the Fed thing. But if we did see any weakness back down to this sort of area, it does look like a buying opportunity for maybe another go at 29.70. So, and there's so much support being left on the way up by this market, by this incredible rise that we've seen. I think at the moment, maybe any talk of an impending bear market for US stocks is maybe a little bit premature. Let's have a look at the FTSE. Again, it's going to be a pretty similar sort of picture. I mean, clearly everything is just being led by US markets at the moment. But there's our big picture view on the FTSE. So again, if we plonked our trend line on the FTSE, it's going to look something like that. So there we go. We're still in an uptrend. The market's still grinding its way higher, and like US markets, I think any weakness in markets like this looks to be something of a buying opportunity. I think the big level, I think if the FTSE fell below these early Feb lows, so what's that, just below the 7,100 mark, so nearly 300 points away from where we are now, then we could maybe build the argument for a deeper market sell-off. But at the moment, it looks like these markets are still strong. Any weakness brings the buyers out, and it's business as usual, really. I think the US tech was an interesting one. There we go. There's the NASDAQ. So the NASDAQ 100 is interesting because even though the broader indices, the S&P and the Dow, it's not really that broad, have gone a bit sideways and a little bit weaker. Look what the NASDAQ's doing. The NASDAQ is still pushing its way higher. So again, the argument from a trend-following technical point of view, if you really want to be a buyer of anything at the moment, the NASDAQ looks to be the best performer out of all of them. And I think it's an interesting market to trade the NASDAQ because it's actually not that volatile. It's not crazily volatile. It does seem to obey the levels pretty well. When we see sort of previous support levels like this here, actually. I mean, it did spike through a little bit, but that's a low from March the 10th, and that's a low from yesterday. So the March the 10th low, about 53.63. It looks like yesterday 53.60, 53.59, and the market bounces 40 points higher. So I think it's it's an interesting market to trade. Not that volatile. It's not like the Dow. It doesn't move a couple hundred points a day sometimes. It moves maybe 50 points, 60 points a day. So I think if you've maybe never traded indices before and fancy dipping your toe in, then a NASDAQ is an interesting one to have a go with. But I think we'll start wrapping things up there. I mean, it's always an odd week when there's a major announcement like this coming out. So 6 o'clock this evening. This Fed announcement. An interesting market to watch. I think arguably the most interesting one from a chart point of view is that Aussie dollar chart, because are we starting to break out of that downtrend? That's an interesting one to keep an eye on. We could see plenty of volatility over the announcement tonight, and maybe a better view tomorrow of how things look. Pound against the dollar is still a market that is driven by the politics at the moment, but I'd suggest, if we looked at it in isolation, down at these levels, we've seen buyers come in for the pound over the last 7 months, so the 120, 121 area. So for me, I'd expect a bit of strength to come back in. Stock markets, let's have a quick look at the S&P. Even though they've drifted off the last few days, if you flip it over to a daily chart, it's nothing, is it? So again, I think the bias in stock markets still very much up. And one that could be selling up soon, but not quite yet, is the price of gold. Because we've had our downtrend in gold that's carried on since mid-Feb. So maybe we'll see a bit of strength coming in. So I think there's plenty there to keep an eye on. But let's get tonight out of the way first of all, and we'll have a better idea tomorrow. So I'm going to start wrapping things up there. So what I'm going to do, I'll put my contact details up. So if you have any questions, you can drop me an email. My email address is david@tradeafter.com. Like I said, on the whole social trading thing, I started blogging about progress with a live account on tradeafter.com. I'm a big fan of social trading. It's a way of eliminating the risk. You don't have the excitement of trading for yourself, but I don't mind. I mean, I still trade for myself, but it's quite an interesting way of maybe smoothing out some of the volatility, so you can see how well or how badly I'm doing. I think so far, I think it's about 1% so far. So it's made about 20 quid, just over 20 quid. But you can read about that there, and you can follow me on Twitter for sort of half interesting charts, and I'm at Jones the Markets. That's it for this week. Let's see what tonight brings with the Federal Reserve. and we'll do it all again this time next Wednesday. But until then, I hope you have a good week, and I hope you find that strategy thing a little bit useful. Okay, thanks.